Hi everyone, how are you? So in modern times, we have a lot of more choices with respect to purchases or how to have like physical assets or any other types of assets. So in the past, we could only make a decision to buy um, like the new asset or used asset, right? But again, in modern times we have a lot of other alternatives like leasing that we are going to see today. So with the leasing alternative, you could simply like rent from a lessor, and of course you can use the asset that you have rented for like several years or several months, depending on the contract. So we have a lot of like modern options, modern alternatives that could combine many possibilities. Right? Maybe you could sell your physical asset and then release it, right? So you lease it back or any other combination. So let's go into our material today. It's about leasing. So who are the parties involved in a lease transaction? So we have two names here. We have the lessor. Lessor is an entity that rents out, right? So is the one who owns the asset and leases it out, and so it will receive the rental payment. Right? We call it lessor, and again, the entity that uses the asset that makes the lease or rent the asset is called the lessee. So we have a lessor and a lessee. Right? Lessor is the one that buys and owns the asset and then rent it out rent it out to a lessee. So the lessee is the entity that actually that rents the asset and uses the asset. Lessor and lessee. So lease decision is a financing decision. So it's quite similar, not exactly the same, but it's equivalent or similar to like financing decision, especially the debt financing, right? Because if you rent a physical asset, then you have to pay uh, got the lease expense, right, or the leasing fee to the lessor. Right? So the lessor is the one that owns and rents it out to us. Right? For example, if we are the lessee, we rent a physical asset from a lessor. This um, this could encompass so many assets from vehicles like corporate cars, um, corporate jets also. Um, Also the like equipment, like electronic equipment, like laptop, mm, theater, and something like that. So there are a lot of benefits from leasing that we are going to see toward the middle and end of our discussion today. But again, this is equivalent to debt financing because we have to pay for a lease expense or the leasing fee or something like that. Okay, so let's proceed it first now. So we have several types of lease or leasing. So this is the most simple one, the operating lease. So operating lease usually is short term. So what is the definition of short term? Usually we say this is less than 75% of uh, the physical assets economic life. So less than 75% of the economic life. So if you ran for 50% of the economic life, then this would be included, or this would be considered operating lease. Right? So short-term and normally cancelable. So easier to cancel, short-term. But this also depends on the clause or the covenant made during the lease agreement. And maintenance is usually included. So the maintenance is most likely borne by the lessor. So as a lessee, we rent the physical asset, but the maintenance would be taken care, would be borne. Maintenance expense would be borne by the lessor or the owner of the asset. Okay? So again, operating leases is short term, and in accounting rule, this is treated as uh, lease expense. So this is uh, like the common renting procedure. So we will pay lease expense, and this would be reflected on the income statement. Right? So lease expense is just similar to interest expense, but of course this is the operating part of operating expenses. But I mean the nature is similar to just paying the interest payment. Right? So lease expense. So the second type is more formal type. We call it financial lease or capital lease. If this is capital leasing, then this is usually long term. Again, what is long term? This is usually defined as 75% or more than 75% or more of the economic life. So if you rent a car for maybe 8 years, considering that the economic life of a typical car is about 10 years, then this would be included. This would be considered a capital or financial lease. And this is normally non-cancelable. You can see here you are tied to a contract for quite a long time, quite a long time, relatively long time, which is 75% or more of the economic life. So most likely the lessor will not agree on any cancelable clause or provision. So this is normally non-cancelable. And maintenance expense is usually borne by the lessee. See here, because you lease for a relatively long time, right? More than 75% of the economic life. In accounting treatment, usually you have to admit this asset as your own asset. Right? So, for example, here you are leasing, let's say, certain asset number 5. So you have most likely you have to include asset number 5 as your own asset. But in your financing side, you have capital lease here. So capital lease is part of your liabilities, but it's not debt. It's not your debt, right? But it's part of your liabilities. So capital lease is included on the balance sheet, right? To reflect the increase in assets that you admit, right, on the asset account. Okay, so for the operating lease that we just saw, usually we don't need to include the lease asset as our own asset on balance sheet, but we simply uh, reflect the payment as lease expense on the income statement for the operating lease case. Okay, so financial lease or capital lease, uh, again, is more formal and more long term, and this is usually related to bigger capital assets like certain machinery, right, or certain vehicles. You see, if you're a corporation and you want to satisfy your executives and maybe your board members, you want to have like the newest models all the time, right? Newest models of maybe laptop or car, or cell phone, or even aircraft and something like that. So if you decide to buy, then it will take, the economic life is long, and once you have it for several years, you realize that the newer models are coming up, and you cannot catch up with the new models because you're still owning the previous version that would last for a relatively long time. So again, there are a lot of non-monetary benefits of leasing. The third type is sell and lease back. So actually you have let's say a set of machinery, certain machinery, and you sell it, but you lease it back from the lessor, right? So this might be a strategy to save some money, right, to be more efficient, or maybe you're seeing that the project life is too short, and you have like remorse, or you regret your purchase decision from the past, so you sell it now and you lease it back from the lessor. So combination lease is a combination between operating and capital lease. So you see, we could combine some features that are not common to each of the type of lease. For example, we might see a combination lease that says that uh, we are having an operating lease. So operating lease is again short term, relatively short term. Maybe you only lease a certain asset uh, for like 50% of its economic life. But let's say the contract says that the maintenance expense is not borne by the lessor, but is borne by the lessee. See, this is called combination, right? Because typically, for an operating lease, the maintenance expense would be paid, or would be taken care by the lessor. But maybe in a certain contract, you see a situation where um, an operating lease in which the maintenance expense is borne by the lessee instead of the lessor. So this is called combination. And we can see a lot of other examples. Uh, Maybe you're seeing a capital lease that is cancelable. So typically this is not cancelable, right, for the capital or financial lease, but maybe in certain cases, in a certain contract, the capital lease or the financial lease is cancelable. And then synthetic. Synthetic means you make it out using your own strategy. So one of the strategy would be to use like SPV. For example, your company is establishing an SPV, a special purpose vehicle. This is a special business unit, a special subsidiary that you use for a special purpose, maybe to buy your assets, like what Enron did. I remember the Enron case. So they were establishing some SPVs they would purchase some rotten assets from their parent company, which was Enron. But in this case, let's say we're using it for a uh, uh, proper case or proper endeavor here. SPV, special purpose vehicle. So let's say you established an SPV, and then the SPV would buy like certain assets. Right? The SPV would buy certain assets from somewhere else, maybe from a manufacturer, and the SPV could actually borrow money to do it. So let's say the SPV borrows money and then buys certain assets here. Let's say assets, like 3 assets or something like that. And then the parent company, here's our company. So the company would lease those assets from its own SPV. So this is called a synthetic lease. So you have an SPV. The SPV is borrowing money and then purchasing 3 assets in our example here, and then these 3 assets are leased out to its parent company. Okay, so this is called a synthetic lease, and there are many other like alternatives to the leasing, right? There are other modern types that we could combine and make for the satisfaction of like both entities, like the lessor and the lessee. So how are leases treated for tax purposes? See here, guideline and non-guideline. So guideline is the a typical one. See, for a guideline lease, the entire lease expense is deductible. Deductible means it's similar to like operating, is an operating expense. So it will be like tax deductible. But for non-guideline lease, only the interest component can be deductible. It's similar to like debt. If you borrow money, can you imagine if you borrow money, uh, the interest expense would be reported on your income statement before tax, right? Before the tax item. Uh, so the payment, interest expense is deductible, but the principal is not. So I hope you still remember. Let me write down again. You have revenues, you have cost of sales, right? Cost of goods sold, you have gross profit, and then you have indirect operating expenses, including here depreciation and amortization expenses, right? Indirect operating expenses, and we get we got operating profit, and then we deduct other income, other incomes or losses. Then we get the earnings before interest and taxes. Afterward, we would deduct interest expense. So you see here, interest expense, right? So it's the interest component of debt payment is tax deductible, the interest expense, but the principal payment is not. And the principal payment will be reported in the like cash flow statement, but not here, not on the income statement. So if we have the guideline, uh, like guideline principle, then we would report, example here, lease expense, and lease expense. So if this is part of the guideline lease, then the whole lease expense will be written like this is will be tax deductible because the tax component is here and the tax is here. So if we have lease expense here, this is called tax deductible because it could reduce your tax payment because it is recorded, it's written before the tax item. So this is tax deductible. But if this is non-guideline, then the lease expense that you could admit uh, as lease expense is the interest component. A similar situation to the debt payment, right? So the interest component would be included here, but the principal component will not. And the principal component will be reported only on the cash flow statement. So this is a case for non-guideline, but the typical leasing would be the guideline lease, where the whole lease expense is reported here on the income statement. So it is tax deductible because it could reduce tax because it appears or it is recorded before the tax item. Okay, so how does leasing affect a firm's balance sheet? We talked about it before. Capital lease, for the capital or financial lease, uh, yeah, usually, the capital lease will require that you have to admit the asset as your own asset, but on the liability side, you have to admit that you have leasing, right? So if you lease, for example, asset number one again, Uh, so you lease asset number one, but this is financial or capital lease, then you include the asset as your own asset on your balance sheet. But here you have to admit that you have capital lease to reflect the uh, to reflect your liability. So it's part of your liabilities, but it's not debt. On the other hand, if this is like operating lease, you don't report, right? So you don't need to report the asset into uh, your balance sheet, but that's the typical case of we call it off balance sheet financing. So usually you only need to report your lease expense on your income statement. That's called off balance sheet financing. But again, accounting rule, accounting principles will change from time to time. It might differ from one country to another. So you have to always check. So the typical accounting rule will treat the operating lease as off balance sheet financing. So it's disclosed only in footnotes. But now they must be capitalized also. I think in uh, like the development of IFRS, right? So if you have to capitalize it, it means that you have to show it also on your asset, even for operating lease. So it changes from time to time. But again, you see the essence here. The gist here is that uh, capital of financial lease is a longer term lease, and definitely it has to appear on your balance sheet. But for operating lease, you have to check the accounting regulation, right? The accounting standard in your country, whether you still can use the off balance sheet financing, so it doesn't appear as your asset on balance sheet, but you just need to reflect the payment as lease expense on your income statement, or you have to capitalize it also, meaning that you have to show it on your balance sheet as well. So again, you have to check your accounting standards from time to time. So what is its effect on capital structure? So basically, leasing is equivalent to debt, right? Not the same, but equivalent. So you can imagine that if you lease an asset, actually you don't buy it, but you lease it. So it's similar to borrowing money and get an asset, right? But except the fact that at the end of the lease, you may not own the asset, right? Different from the case of debt. If you borrow money and then buy an asset, then the asset is yours even after you finish repaying your debt. Okay, so substitute for debt, right? Because it's equivalent. And leasing uses up a firm's debt capacity. You can see from our uh, hypothetical balance sheet again here. So capital lease or any type of lease, maybe in modern accounting, uh, is part of liabilities. It's not debt, but part of liabilities. So it's equivalent to debt, right? So if you use the capital lease more and more, it will eat up your debt capacity, of course, right? Because they have the same nature, which is a liability. You see a question here: if a firm has 50-50 target capital structure, 50% liabilities and 50% equity, but half of its assets are leased. So we have so you see here half of the assets are leased. So it's just the same as uh, taking the place of liabilities, right? So it will uh, again it will eat up your debt capacity because lease is also a liability on the right side of your balance sheet. So we'll see an example here, example of calculation. So assume that we have a company here, Louis Securities, that plans to acquire some new equipment having a 6-year economic life. But you see here, the firm could obtain a 4-year lease, so the economic life is 6 years, but this company wants to rent for 4 years only, which includes maintenance. So the maintenance expense would be borne by the lessor. Right? So the lease expense includes maintenance expense already. Okay, so four out of six. So we could approximate that this would be an operating lease, right? So 4/6 or 2/3, right? 2/3 is at 60+%. So this could be more or less uh, defined as an operating lease. And further information here, it fulfills the guidelines, right? So the whole lease expense could be included on your income statement, the whole lease expense. So it would be tax deductible because it reduces the tax payment. Right? So the rental payment would be 260,000. And the important information here is that at the beginning, so the beginning period, remember when you study the time value of money, you have the beginning of period or end of period cash flow. Also uh, have to take the information into account carefully. The equipment cost is 1 million. If you buy it in the market, you have to pay 1 million. So loan rate, this is the discount factor for debt, right? Because if you borrow money, uh, the interest rate or the coupon rate will be 10% for you. So you get this information, of course, from a survey, or you ask a bank for a quote, right? Or you ask your investment bank to estimate the coupon payment that you have to make if you issue a series of bond or something like that. But essentially, this is uh, the interest expense that you have to pay if you borrow money. Right? So loan rate will be 10%, and your tax rate is 40%. Uh, this is the highest bracket, right? And it's for the sake of this is for the sake of the simplicity or ease of calculation with number at 40%. And you see here, because you lease the equipment for 4 years, then in the United States you'll follow a 3-year makers numbers, right, for depreciation. In other countries, you might simply use the straight line method, straight line depreciation. So you divide, for example, the 1 million at 1 million, because you rent it for 4 years. Uh, yeah, you see the depreciation as 1 million divided by, what's it, 6, I think. Yeah, 6 years. Economic life is 6 years, so 1 million divided by 6. Okay, but you only rent it for 4 years, so you can adjust the depreciation expense. Right? If you are a lessor, but if you are lazy, you don't pay for the depreciation expense, because the oh, sorry, because this is operating lease. Uh, yeah, usually you don't own you the an operating lease. In operating lease is again the definition, especially the conventional or classical definition. You are not owning the asset, right? So the depreciation um, most likely belongs to the lessor, right? Not to the lessee, right? But to lessor, then you can depreciate this one, right? Because this is still yours, and you just lease it out for 4 years out of 6, so it's below 75%. But for a capital lease or financial lease, uh, you will depreciate the equipment or the asset, because again you have a long-term lease which is more than 75%. But this one again, this is operating lease, 4 out of 6. So the depreciation will be conducted by the lessor, not by the lessee. If company borrows and buys, 4-year maintenance contract cost, maintenance expense is 20,000, but the contract says that the maintenance here would be conducted by the lessor, right? This typical operating lease, the maintenance will be conducted by the lessor. The 20,000 will be paid by the lessor. And we find out that the residual value is expected to be 200,000 because the economic life is 6 years, but we will stop the rent period after year 4. And based on research, the residual value of the equipment will be around 200,000 after the lease period is over. Okay, now you see the depreciation expense. So depreciation expense, because we follow the Macker's book, right? For 4-year depreciation, we use the 3-year Macker's. And what's the meaning of Macker? Macker's is the American book for depreciation. So the percentage of depreciation, percentages of depreciation are not equal, right? For what's that for each year. So you see here, 33% in the first year, 33 and 1/3% in the first year. In the second year, it might be different percentage, and also for the third and fourth years. Right? So you could imagine for the straight line method, the percentage would be 25% every year. Right? Could imagine easily if we have 4 years with 25% every year. But here, and actually to be more precise, we should no they should have used the 6-year depreciation from the Mackers, but we only ran for 4 years, right? So again, the depreciation is conducted by the lessor, and not by the lessee in this case, because this is an operating lease. Okay, now we start making a comparison. So um, which one has a higher value, or least cost alternative? Whether you lease it, you lease it from a lessor, or you borrow money from a bank or from somewhere and then buy the equipment. Now we'll compare. So this is the first alternative, the value of owning. So you might have to borrow money, right? Yeah, this is the like a comparison of two alternatives, right? You borrow money and then buy the equipment. So you have debt here. You have debt to repay. The second alternative is to lease the equipment. So this is the first alternative, which is to own it, right? So you borrow money and you buy. And what is the suppose here you issue a bond, right? You issue a bond and then you pay. And how much again? 1 million. How much is it? At 1 million. And if you borrow money by issuing a bond, let's say the coupon rate is 10%. So what is the coupon payment every period? So every period you have to pay 10% of 1 million. So it would be 100,000. Okay, 100,000 is your interest expense. But remember here, right? So if this is like 100,000 per period, and again, this is recorded before the tax item, so this is tax deductible. And here, the tax rate is 40%. Let's check again. Yeah, here, the tax rate is 40%. So obviously, this interest expense could reduce your tax payment, right? So this should be tax deductible in our analysis. So 100,000, and we could reduce 40% of it. So the after tax interest expense is 60,000. That's why here you see, if you borrow money, you borrow 1 million, you pay 100,000 per period. But with the existence of 100,000, you could reduce your tax payment. So this is tax deductible, right? So 100,000, but the after-tax value of the interest expense payment is 60 instead of 160, right? And of course, the 1 million is the principal. The principal is not tax deductible. It's not tax deductible, right? Because it's not reported on your income statement. Okay, so this is the amount that we have to pay after tax, 60, 60, 60, and 1,060,000. Okay, so next one is, see here, if you borrow money and buy the equipment, you borrow money and buy the equipment, you have to pay for the depreciation expense. And depreciation expense is here. Let me write it down again. So you have indirect operating expenses, you have lease expense, and then you have depreciation and amortization. Or let's say here depreciation expense. So similar thing here. If you own the asset, you borrow money and then buy the asset. The asset belongs to you, so you are the one who should depreciate this machine or this equipment. And the depreciation expense is here. Again, this is recorded above the tax item. So the depreciation expense is tax deductible. It could reduce your taxable income, right? And the depreciation expense here in this example is following the makers, right? For example, the first year depreciation expense for this machine is 333,000. So you could imagine, right? In the first year, you pay 333,000, and because of this depreciation expense, your tax will be lower, right? Because again, depreciation expense, it increasing the operating expense, thus lowering the earnings before tax, right? And of course, your tax payment will be lower as well. So we could save 40% of it, right? It's tax deductible. So the tax benefit is 133,000 for the first year. We call it depreciation tax shield. Okay, so again, this is like depreciation tax benefit or tax shield because we have to we have to record the depreciation expense. Depreciation expense will lower our tax payment, our taxable income, and then the tax payment, of course, by 40% of it, 40% of the depreciation expense. So these are the tax shields for 4 years. You see here the numbers are not equal because they're using Maker's book. If we use the straight line method, these numbers would be similar or the same. And then what else? If you borrow and buy, you have to pay for the maintenance expense. And the maintenance expense 20,000 at the beginning. See here. So similar situation here. If you pay maintenance expense, it will be here, right? Operating expenses, right? Part of operating expenses, you have maintenance. One of them is maintenance expense. So with maintenance expense, that appears here above the tax item. Again, the tax item is down there after the earnings before tax. Well, the Maintenance expenses here. Okay, so again, this will lower the earnings before tax or the taxable income. So it has a tax benefit as well. So again, the maintenance expense is 20,000. Right? We have to pay the minus here, but we get the tax benefit. So similar to this one, right? The shield. So maintenance tax shield is 40% of this, right? 40% of this. So we get 8, right? So the net or the after tax maintenance expense is about 12, right? Minus 12 instead of minus 20. So one package here. So we have to pay 20 in the beginning of the period, but actually the tax saving or tax shield from the maintenance expense is 40% of it. Next one, if you buy the asset, yeah, this belongs to you, right? Because if you buy the asset at the end of year 4, the residual value belongs to you because this is your asset, right? So 200,000. But of course, if you get the residual value by selling it, you have the revenues from selling the asset, then you have to pay the tax. You have to pay the tax, 40% of it. So the net after tax residual value is 120, right? 200, but have to pay the tax. You sell the assets. It's included in other income. So we sum them together. You see the cash flows here. Net cash flows from year 0 to year 4. And then we put into the net present value, right? The net present value calculation. The cash flows again. Minus 12, and then 61, 106, minus 13, and 910. And what is the discount rate here? Because you borrow money, right? You borrow money to buy the machine, assuming that you borrow 100%, right? So you borrow money to finance the equipment by 100%. So there's no equity at all in purchasing the asset. So we use this one, like the cost of debt, as the discount factor, because the cost of, see here again, let me write down. So net present value is future cash flows discounted back, but discounted at the cost of capital. That's the initial investment, or year 0. So in this case, the cost of capital is only comprised of the cost of debt, because um, the purchase of the equipment is financed 100% by debt. Right? Okay, so here, see, we could find like NPV would be minus 12 divided by 1 plus the cost of debt is what, 10%, right? You see, the cost of debt is 10%, but again, uh, if you watch a video on the cost of capital, you'll find out that the cost of debt is tax deductible. And the same principle here. If you have a higher level of debt, you pay a higher amount of interest expense. And interest expense is recorded before the tax item. Right, so interest expense again is here. It happens before the tax payment. So it could reduce the taxable income and also, of course, the tax payment. So cost of debt is tax deductible. Okay, so that's why the NPV here would be minus 12. We have to discount it back at 10%, but after tax would be 6, because the tax rate is for 40%. Again, the cost of debt is actually 10%, but this is after tax, or tax deductible here, to the power of 0, right, plus 61 divided by 1 plus 10%, but the tax benefit of 40%, so 6% to the power of 1, and so forth. Right? 106 divided by 1 plus 6% to the power of 2, and so on. So we get minus 591,793. So this is net present value for borrowing and then buying the asset. So you own the asset, right, instead of leasing. So now let's compare it with the second alternative. Second alternative here is leasing. So you need to lease for this one, right, for this alternative. And you see the information is quite simple here. This is an operating lease, and the lease payment is 260,000, and it meets the guidelines principle. So the whole lease expense could be admitted or could be recorded on your income statement. No problem. So you have to pay the lease expense, and of course lease expense again. Lease expense say is here. Lease expense. So it happens again before your tax item. So lease expense is also tax deductible because it has it has a service to lower your taxable income and tax payment. So let's see here. Okay, so you pay at the beginning of period. It says, right, the clause says that you have to pay in the beginning of each period. So you pay 260, but again, this is tax deductible. I remember because again, lease expense is part of the operating expenses. So uh, you could lower your taxable income by paying the lease expense, and you will lower your tax payment, of course, by 40% of it. So the net, what is the net value here? At 154. So minus 154 is the after tax lease expense. Sorry, 156. So minus 156 would be the after tax lease expense, right? And here we stop here because this is the beginning of year 4, and we have to pay in the beginning of each period. So we recalculate here the NPV. Again, this would be this one, 156 divided by 1 plus 6%. Again, the cost of debt is 10%, but the after-tax cost of debt after the tax deductibility of 40% is 6%. So this one, again, minus 156 divided by 1 plus 6% to the power of 0 plus minus 156 divided by 1 plus 6% to the power of 1, and so forth. And we get minus 572,990. So you could see here, if you borrow money and own the asset and buy the asset, the NPV is minus 591,000. But if you lease the asset, the NPV is minus 572,990. So of course, which one is higher? The NPV of leasing is higher. right? Minus 572,000 is higher than minus 591. So if you are based on the financial comparison only, then it's better to lease. Of course, your final decision will be affected by many other decision points, many other aspects. Right? But from the financial perspective, financial point of view, the net present value of leasing is higher than that of owning, borrowing and owning the asset. So we call it what, net advantage to leasing, NAL, now, right? Net advantage to leasing is the present value of leasing, which is minus 572,990 minus the present value of borrowing and owning. That is minus 591,000 something. So we have a positive net advantage to leasing. Again, from a financial perspective, it's better to lease in this case than to borrow and own. So you see, every clause and every agreement would be different, like one from another. So there's no single pattern, but the principle still holds, right? You see, we are learning the principles here, but again, every contract would be different. Every clause would be different one from another. So if the equipment is purchased at the end of the lease, so for example, here in this case, you don't return the asset to the lessor at the end of the lease period, but instead you could buy the equipment. So we are a lessee, right? If we are a lessee and we lease the equipment, but at the end of year 4, we have an option to purchase the equipment at its residual value. And let's say the residual value is 200,000. So at the end of year 4, you have to pay 200,000, right? You have to pay 200,000, and uh, this will affect the depreciation method. So again, this would be different from one contract to another. But in this example here, you see here, uh, this 200,000 will be depreciated with the same schedule as it were purchased new, right? So 4-year depreciation or 3-year makers, right? So this gives an outflow of 200,000 at the end of the lease, and then 4 years of depreciation tax saving. So see, so let me here, yeah, here. So we pay, we've got 260 for the lease, right? So the lease expense, and then the tax savings here, again, your lease expense would lower your taxable income, right? Would lower your earnings before tax. So it has the service of lowering the tax payment. That's why we we have a tax shield or tax benefit from the lease expense, because lease expense is recorded above the tax payment, right? So this is tax deductible. So minus 156. But now, if the clause says that you will buy the equipment at the end of year 4, then we have to add depreciation expense, because now it belongs to you, right? The asset belongs to you from the beginning. So the leasing payment would be, you have uh, lease expense, and of course this is tax deductible, right? Tax deductible. So you have it here, beginning of year 1, beginning of year 2, beginning of year 3, beginning of year 4. And because the contract says that you own the product at the end of year 4, then the depreciation belongs to you, right? So you have depreciation expense. And again, depreciation expense is tax deductible. So you have to calculate the after tax amount. and we saw it before. The after-tax amount, uh, yeah, here. This is the shield, right? So depreciation shield from here. So I should write it more properly. This is the depreciation shield, depreciation expense tax shield. Okay, because depreciation expense appears on your income statement, yeah, but you don't really incur cash. You don't really pay cash. So uh, you admit the expense, but you don't incur cash. But with the with the existence of the depreciation expense, your earnings before tax will be lower, and so will your tax payment. Right? So here, let me write it. This is after tax, this expense, and then the next one is the depreciation expense tax shield belongs to you. You could enjoy the tax shield from uh, your admission of depreciation expense because now the depreciation belongs to you because you own the asset at the end of year four. So it's here, year one, year two, year three, and year four. And you have the uh, residual value here. So let me write it again. Lease expense, but after tax, you pay here, minus you pay depreciation expense tax shield, you get tax shield, and then the residual value, you have to pay here. But this is, remember, this is tax. So if you buy something, so so you have to buy like a certain asset here. Uh, you have to pay the tax as well, right? Okay, so you pay you get the tax deductible also. Okay, so this would be the pattern of cash flows uh, if you if you are going to buy the equipment at the end of the lease period. So next scenario, for example here, if the residual value that will appear at the end of year four would be 0 or 400,000. So we know that the expected value of 200,000. Uh, if you if you think that the probabilities of happening are 50% for 0 and 50% for 400,000. So you could imagine that for 50% multiplied by 0 plus 50% multiplied by 400,000 is 200,000. So the expected value is 200,000, assuming that the probability of or the chance of happening for each scenario is 50%. But this fact shows that the residual value or the purchase of the asset at the end of lease period is riskier than normal. So most likely, see, cash flows here, um, the discount rate applied to the residual value should be higher than 6%. So in our case here, could imagine here. Okay, so when we calculate when we calculate the NPV, it is minus 12. So minus 12 divided by 1 plus 10%, but after tax would be 6%, right? So minus 12 divided by 1 plus 6% to the power of 0. And this one would be 61 divided by 1 plus 6% to the power of 1 plus 106 divided by 1 plus 6% to the power of 2. This one is minus 13 divided by 1 plus 6% to the power of 3. But this one we have to be careful because uh, up to this point, this is like 1000 minus 100 minus 1060 plus 30. So it's minus 1030 divided by 1 plus 6% to the power of 4. But this one, yeah, is different because now the 120 is divided by 1 plus a cost of debt that is higher than 6% because we are not sure about this, right? Because the story says that it could be 0, it could be 400,000. But the expected value or the weighted average value is 200,000. So we might have to might have to discount it back. The 120, it should be discounted back at a higher rate, right? Maybe not 6%, but 7% after tax cost of debt, right? 7 or 7.5% or something like that. On the other hand, if the residual value is is an outflow, for example, if you have to you are a lessor and you want to sell it, then the increased risk would be reflected by a lower discount rate. So this is the other way around, right? If you're a lessor, you're going to sell the equipment at the end of the lease period, and the uncertainty is high, then this will be reflected by a lower discount rate for you because yeah, you could be selling it at 400,000 or 0 with the expected value of 200,000. So the risk is basically borne by the lessee or the buyer of the equipment in the end of the lease period. But again, this should be analyzed case by case. Have to be careful with with following a pattern because every case would be different. That's why you see when we study a certain topic like lease, we can learn the basic principles, but uh, case studies would be very important to improving your skills, right? To the improvement of your skills because you can see a lot of like changes right in real life reflected by each case. So lessor owns the equipment when the lease expires. This is a typical case, but we see some contracts before that uh, that the lessee will buy. So usually, if this is the common case, uh, the lessor will bear the residual value, right? Residual value risk. But if the contract says that the lessee will buy the equipment at the end of the lease period, then the residual value risk will be passed to lessee. See, a different case, right? But a typical case, because the equipment will go back, will return to the lessor, then the lessor will bear the residual value risk. So what about the lessor? Now we'll analyze the feasibility from the perspective of a lessor. So to the lessor, I think a lease is like an investment. So it's like you buy the machine, you buy the equipment, and then you lease it out to a lessee. So we'll compare. I will compare return on making the lease with the return available on alternative investments with similar risk. So let's see an example. We continue the previous example here. So rental payment, let's assume that the rental payment is 280,000, not 260,000 anymore, but the lessor is estimating another scenario where the rental payment or the lease expense is 280,000. So now you are a lessor, you have to you buy the equipment at 1 million, right? You buy the equipment at 1 million. And again, the depreciation belongs to you because now uh, you own the asset and you lease it out as an operating lease. Right? Again, if you lease it out as a financial or capital lease, then the depreciation belongs to the lessee. But here we are talking about operating lease, then the depreciation belongs to you. You do the depreciation. So we follow the Maker's book, 4-year depreciation. But remember actually the economic life is 6 years here. So I think this example is not entirely proper because the depreciation should be conducted for 6 years. But anyway, you can catch the principle here. So depreciation expense, and this is not the expense, but the tax shield. So I will show you again here. You pay the depreciation expense here. So with the existence of depreciation expense, you could lower here. You can lower your EBT, right? And of course, with the lower EBT, you pay a lower amount of tax, right? So depreciation expense is an expense, but you don't incur cash. So there's no cash outflow whatsoever here. But with the depreciation expense, you can get you can get the tax shield or tax benefit. So you don't pay cash, but you admit there is depreciation expense. So you get a tax benefit from admitting the depreciation expense, and the amounts are here. Okay. So tax shield from depreciation expense. So it's not the depreciation expense, but 40% of the depreciation expense, which is the depreciation expense tax shield. And remember again, you have to pay the maintenance expense. Maintenance expense. But again, maintenance expense, you pay by cash, of course. But the appearance or the existence of maintenance expense will lower your earnings before tax. So you get the tax savings of 40%. And then because you own the asset and you lease it out as an operating lease, you get the payment here. Right? You get the payment. But remember, when you receive money, you receive revenues, lease revenues, you have to pay the tax. Right? So this is the opposite way. With the incoming revenues, you have to pay the tax of 40%. Right? And then let's say here at the end of year 4, the equipment will go back, right? Go back to you. So we still have residual value of 200, but again with the residual value of 200, if you sell it, you still have 200, but with the sale of your equipment, you have to pay the tax of 40%. So this would be the cash flow from year 0 to 4, and when you calculate the NPV with a discount rate of, again, the cost of debt, let's say you borrow uh, to buy the equipment, you borrow, and the cost of debt is 10%, and the after-tax cost of debt is 6% because the tax rate is 40%. Right? So it's after-tax cost of debt 6%. So again, you do the NPV minus 844 divided by 1 plus 6% to the power of 0 plus 289 divided by 1 plus 6% to the power of 1 and so forth. And you get here 25,000. So it's positive, right? Positive. So positive NPV, meaning that this is worth doing. So you could borrow money, buy the asset and lease it out for 4 years as an operating lease. The IRR is 746, which is slightly higher than the after-tax cost of debt. And here your cost of capital is entirely comprised of cost of debt because you don't use equity to buy the equipment. Okay, what if the lease payment is not 280 but only 260? Right? We find out that the NPV for the lessor is minus 18,000. So this is not feasible, right? Not worth doing. So what is the main implication here? This is only feasible if you lease it out at 280,000 per year, not 260,000, right? If you rent it out at 260,000 annually, then the NPV is not positive. So this is not worth doing. So what about the cancellation clause? Cancellation clause. If you can cancel anytime, or you can cancel in the middle of the lease period, this will lower the risk of the lessee. You can imagine, right? You rent it for 4 years, but after 1 year, you decide to send it back to the lessor. So why? Because maybe it's outdated. You find a newer version of the machine and you just cancel this one. You return it to the lessor and you lease it. You lease a new one from maybe somewhere else, from another lessor or something like that. So to account for this, the lessor would or might increase the lease payment, right? If the agreement or the lease contract enables the lessee to cancel the contract, right, in the middle of the period, or maybe early part of the period, then the lessor, of course, will charge a higher lease expense, right? Higher leasing fee from the lessee. Other issues, higher residual values, have to consider this one. Of course, if the residual value is higher, then it's better to own the asset, right? So if you find out that the residual value might be high for certain machinery, right? So because of the slow technology in the pertaining area, so the residual value might be still very high. So it's better to own the asset, or you lease the asset with the agreement or with the eligibility to own the asset at the end of the lease period. So you could there could be like two possible alternatives, right? So you own the asset directly, or you simply lease the asset, but you include a clause, right, in the contract that says that you have an option to buy the asset at the end of lease period. So that would be, I think, a better way. Spreadsheet model, we have seen it before. What about the tax law? Of course, tax law, the higher the tax rate, then it will be very profitable, right, to be able to depreciate the assets in the capital or financial lease, right? And the maintenance expense will be tax deductible as well. The the yeah, all kind of expenses that appear before the tax item will be tax deductible. So the tax regime would be an important consideration whether you want to borrow money and buy, or you want to lease the asset. And also other things like here, investment tax credit. Maybe in some countries we have investment tax credit. So if you buy something, you might, especially the a capital asset, like machinery, or certain vehicles and certain electronic equipment or something like that, you might get tax credit. So this will affect the decision as well, because now it's more attractive to buy instead of to lease. and tax rate differential again, and alternative minimum tax. So in some countries, you have a lot of like tax regime, tax credit, deductions, and all sorts of like tax benefits and yeah, something like that. And then numerical analysis often indicate that owning is less costly than leasing. It's not necessarily true, but in typical case, is that owning might be more interesting. But in our example today, we saw that the advantage to leasing, right? The advantage to leasing is positive, meaning that it's better to lease than to borrow and buy, right? In our example. But again, the case would be different, right? Would differ one from another. So the decision would be different as well. But you see some factors or some aspects that make leasing very popular. First one, maybe the provision of maintenance services, especially the operating lease. I, in many of lease contracts, maintenance would be provided by the lessor, especially if the lessee doesn't have the expertise to maintain it. Like for example, the in jet engine business, I think nowadays, if you buy if you lease jet engines from Rolls-Royce or from General Electric, they will provide the maintenance, right? And of course, with the provisions of maintenance, that will be incorporated into the lease payment, right? Of course, the lessor will calculate everything, right? They will ask the lessee to pay more, knowingly or unknowingly. But see, with the uh, special expertise required for certain industries, it's very important to get proper maintenance from the lessor. And then risk reduction for the lessee because of the project life. Maybe project life is short. If you lease, yeah, this is like the fit, right? The matching between the project life and the lease period. So if the project life is short, if you lease certain machinery for a relatively long period, then it's not really interesting because when the project life is over, you might still have this machinery under your lease, and maybe it's outdated, right? Who knows? So we have to always match, right, between the project life and the lease period to make sure that uh, uh, they are nicely matched and will not be outdated in the wake of the project life. Residual value again, we saw this one before. If the residual value is high, then it's better to own the asset. But if the residual value is not certain, it's not certain or could be very low, it's better to lease because at the end of the lease period, you return this product or this asset to the lessor. The operating risk, you have the maintenance expense and something like that, related to this one also, and the capability of operating the equipment, right? So, for example, again, the jet engines, if you're an airlines company, you operate the aircraft to make money, right? To serve your customers and make money. But uh, many times, airlines company, you're not really an expert in jet engine or some uh, high tech, super high tech, and specific things like that. So it's better to lease it, right, from the producer, and then they will provide the operational help, operational facilities like the maintenance and something like that. And also here, portfolio risk reduction enables lessor to better bear this risk, right? So the risk, this kind of risk, right, the maintenance and then project life, residual, operating risk, because a lessor usually owns so many models and so many products or so many assets. So uh, their volatility, their revenues and volatility will not depend on one product only. So it's very different from a specific company. For example, we have a company that needs this machinery, uh, but again, the important role of this machinery is so high to the company, right? So if something happens to the company or if this is outdated, then we will lose a lot of money. But for the lessor, it might sell a lot of machinery, a lot of series, right? A lot of assets even. Then again, the portfolio owned by the lessor would enable them to diversify this kind of risk. Okay, so it's very interesting uh, comparison here, right, between leasing and owning. Owning, of course, you can assume that you borrow and own. You can compare the decision with leasing, right? So there are a lot of other factors that you could build upon the model, but the principle is always the same. We have we could enjoy after tax or the tax shield for tax shield from certain expenses, right? Both for owning and also for leasing. So again, every case would be different. So we have to pay attention to uh, all the clauses of the agreement. Who will bear, what type of leasing is it, right? Be it operating lease or financial lease, right? And who will bear, who will own the right to depreciate the product, right? The asset. Again, in a capital or financial lease, usually the lessee has the right to depreciate the asset. But for operating lease, like our example today, depreciation is conducted by the lessor. And then who will bear the maintenance expense? Uh, what will happen to the asset at the end of the lease period, right? Whether the lessee will return the asset to the lessor at the end of lease period, or the lessee has the option to buy the asset, right, at the end of the lease period. So all of those will affect the cash flows, right? Cash flows from one year to another, and it will affect the tax shields, and of course toward the end the cash flows for all the years of analysis. Okay, so I hope you gain some uh, knowledge, right, in the form of like basic principles of comparing leasing and owning. Thank you for watching, and we'll see you again in the next topic. Thank you.